Investing with inflation fears. 7 smart investing strategies. Inflation presents unique challenges for investors. Even if your investments are growing in value, inflation reduces that value on the back end. The only way to deal with it successfully is to be sure that your money is in investments that are likely to benefit from inflation, while avoiding those that tend to be especially hard hit. So how do you find investments that benefit from inflation instead of losing their value? Let's find out. There are no guarantees when it comes to investing in inflation. At best, certain investments may be inflation safe, but returns can never be guaranteed. This is especially true in the rapidly evolving coronavirus-driven economic environment we're now in. Indeed, if employment continues to decline, and consumption with it, a deflationary trend will prevail. Inflation is the term used to describe the steady rise of prices for goods and services that affects all areas of the economy. Over time, inflation can erode the purchasing power of your dollar and also chip away at your investment returns. But with some foresight and planning, it's possible to protect your money. The solution is investing for inflation, choosing investments that will give you a return greater than the current inflation rate, or at least keep up with it. Here's how investors can protect themselves from rising prices and which investments make the best inflation hedge. Number 1. Treasury Inflation Protected Security. Treasury Inflation Protected Securities, or TIPS, are investments that account for inflation. More specifically, they're inflation-protected bonds whose principal rises when there is inflation and falls when there's deflation. They pay interest twice a year at a fixed rate, which is applied to the adjusted principal. These interest payments increase with inflation and decrease with deflation. The difference between the inflation rate and the nominal interest rate is your real rate of return. TIPS are worth the investment if the return on investments minus inflation yields positive. The concern may be that if inflation is lower than expected, the return on conventional bonds may be better. Experts say that if interest rates don't increase, it could be an excellent time to move out of TIPS, even if TIPS is a well-known inflation hedge. Because their yields are so low, they may not be as appealing. The solution? You don't have to choose just one inflation hedge. You can have multiple inflation-protected securities in your portfolio. TIPS are issued at either 5, 10, or 30-year terms. At maturity, investors either receive the adjusted principal or the original principal. If you choose to sell TIPS before they mature, there is a possibility that you could get back less than what you initially invested. If you want to diversify your portfolio to account for inflation during an inflationary environment, TIPS can yield more than conventional bonds. You can buy TIPS through the Treasury website or your brokerage. Number 2. Commodities. Commodity prices are believed to be a leading indicator of inflation through 2 basic channels. Leading indicators often exhibit measurable economic changes before the economy as a whole does. One theory suggests commodity prices respond quickly to general economic shocks such as increase in demand. Commodities are another suitable hedge against inflation. These are raw materials, including oil, natural gas, precious metals, wheat, and corn. They can be traded on the futures market, where commodities contracts are bought and sold at a particular time in the future. Commodities naturally protect against inflation. As inflationary pressures prop up prices, commodity prices will subsequently increase as well, and investors can get a good return on those investments. Given that there is some volatility tied to the commodities market, experts recommend investing in commodities through a diversified investment vehicle, such as a mutual fund or exchange-traded fund. Gold has historically been a popular commodity for protecting investment portfolio against inflation. Since gold prices coincide with inflation, you have a better chance of strengthening your purchasing power on potential investment returns by investing in gold. Even though owning physical gold is preferable, experts say it can be difficult to purchase due to its higher barrier of entry, but advice gold ETFs can provide an easier way to access gold. Globalization has increased the interconnectedness of economics, and when commodity prices rise from a strong dollar, this typically results in domestic deflation. While commodity prices are not 100% indicative of inflation, they can be a good starting point when attempting to hedge against inflation. Number 3. Real estate. There are many advantages to investing in real estate. This asset class has intrinsic value, provides consistent income through dividends, and is a natural inflation protector. Real estate can keep up with inflation because of the necessity surrounding it, experts say. People will always need to live in homes or apartments, which is why those who invest in this asset class can keep up with inflation. Everyone still uses real estate regardless of what the economy and markets are doing. And while they might recede in returns, overall, real estate will be more stable and a pretty quick recoverer when things start to get better. Similar to commodities, the value of the real estate increases with inflation. For example, if the prices of raw materials to build a home or property increase, the value of that property will increase. Hard assets naturally hedge against inflation because you're holding an asset that appreciates at the same rate as inflation. Because real estate is a tangible asset, however, it's illiquid. As an alternative, you may want to consider real estate investment trusts, or REITs, which are more liquid investments that can be bought and sold quickly in the markets. In many cases, you can buy a bundle of REITs in either a mutual fund or ETF. Investors should possibly consider assets that will pay an income stream. This is another benefit that real estate investments can offer if inflation rises, because tenants still need to pay rent. Number 4. Use debt to deal with inflation. Debt may seem like the opposite of an investment, but incurring it can also be an excellent financial move when inflation is rampant. Experts note that inflation makes it cheaper to service, that is, pay some types of debt, as long as it has a fixed interest rate. In the same way that inflation eats away at the value of your cash, it also eats away at the value of your loan. This benefits individuals that have acquired loans or mortgages in the past, before the period of inflation set in. Many economists agree that the long-term effects of inflation depend on the money supply. In other words, the money supply has a direct proportional relationship with price levels in the long term. Thus, if the currency in circulation increases, there's a proportional increase in the price of goods and services. For example, $1 in 1990 is equivalent to about $2 today. So a $1,000 mortgage payment 30 years ago would now be worth about $2,000. But after all that time, you'd still be paying $1,000 per month. So the value of what you need to pay is reduced by about half. Effectively, you're paying half as much each month to service the debt. If you can refinance, try changing your loan or mortgage to a fixed rate rather than a variable rate. That will leverage inflation to your advantage. Number 5. Avoid long-term fixed investments. The worst investment to put money into during periods of inflation is long-term fixed-rate interest-bearing investments. These can include any interest-bearing debt securities that pay fixed rates, especially those with maturities of 10 years or longer. The problem with long-term fixed-income investments is that when interest rates rise, the value of the underlying security falls as investors flee the security in favor of higher-yielding alternatives. That 30-year bond that's paying 3% could decline in value by as much as 40% should interest rates on newly issued 30-year bonds rise to 5%. Long-term fixed-income investments are excellent when inflation and interest rates are falling. But if you believe that inflation is about to take off, you'd be better off moving your money out of long-term fixed-income investments and into shorter-term alternatives, particularly money market funds. Before we look at the last 2 ways to invest with inflation, if you haven't yet subscribed to our channel, kindly do so by clicking on the subscribe icon below. Please give us a like, share the video, and don't forget to turn on the notification bell for timely updates of our latest uploads. Let's continue. Number 6. Emphasize growth in equity investments. Recent upticks in inflation have renewed interest from investors in assets that may help preserve the actual value and purchasing power of their portfolios. The good news is that the typical investor's portfolio will likely contain all the inflation-fighting tools they need, such as stocks and bonds. However, the best inflation-fighting asset for an investor is actually perspective. That means taking a step back and looking at the big picture. For most investors, the purpose of their investment portfolio is to fund either current or future spending, because many people expect the prices for goods and services to be higher in the future. They need to find ways to preserve their purchasing power, and their assets need to grow at a rate at least equal to the rate of inflation. Many investors try to balance out their equity portfolios by investing in high dividend-paying stocks or in growth and income funds. This can work exceptionally well during periods of price stability, but when inflation accelerates, it can hurt your investment returns. This is partly because high dividend-paying stocks are negatively affected by rising inflation in much the same way long-term bonds are. The better alternative is to invest primarily in growth-type stocks and funds. It would be best to emphasize on sectors that are likely to benefit from inflation. These can include food, energy, healthcare, building materials, and technology. Since all are likely to rise in price with inflation, they're likely to perform better than other equity sectors. You can invest in these sectors through an ETF fund, or you can buy specific stocks that have growth potential. Once you have identified what you want to buy, you can purchase it through a broker. Number 7. Digital currency. People invest in cryptocurrency for different reasons. While some want to book profits, others see a quick way to grow their wealth. Still, there are others who see it as a store of value. But most of them would agree that cryptocurrency, especially Bitcoin, is an excellent hedge against inflation. That is, when inflation rises, the value of money depreciates. To beat this recurring problem, many people invest in assets that are almost certain to increase in value at a rate more than inflation. This strategy ensures that the net value of their investment remains positive despite inflation eating into the value of their savings. The rapid growth of Bitcoin over the past couple of years has made investors see the potential to beat inflation in it. So instead of putting their money into gold or realty, many of them are entering the cryptocurrency industry. According to a Bloomberg report, JP Morgan's analysts wrote that the recent rally of Bitcoin was driven mainly by the perception that it was a better inflation hedge than gold. Investors around the world are worried about increasing rates of price rises, and this has revived their interest in inflation hedges, including Bitcoin. While inflation is generally considered a positive attribute of a healthy economy, it's often unwise for people to hold their savings in cash due to cash losing purchasing power over time. This has a lot of market participants turning their hard-earned money into a store of value investments like stocks, bonds, crypto, Bitcoin, or precious metals, among others. It's important to note, though, that this doesn't make Bitcoin an inflationary hedge, which inherently is an investment that you think will gain value. So if you're looking to hedge, Bitcoin is the most similar asset to gold or oil, in that it's just simply a way of converting time and energy into a single asset. That's all on our video about investing with inflation fears, 7 smart strategies. If you enjoyed it, be sure to subscribe to our channel for more of our amazing content. Please give us a like, share the video, and don't forget to turn on the notification bell for timely updates of our latest uploads. We value your feedback. Feel free to share your thoughts with us in the comments section below.